You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome to this week's edition of the Systematic Investor Series with Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, where we share our knowledge and sometimes painful experience, not just with the tech we use, of what it's like to be a rules-based investor, and where we end up with some Q&A-based questions and answers as we are trying to make this a listener-driven show. So if it's the first time you're tuning in, welcome. It's great to have you here, and we look forward to our journey together. As usual, let me start by saying good morning to you, Jerry, and good afternoon to you, Moritz.
Good morning.
Hello, Niels. Hello, Jerry. Great to be back.
Yes, we're overcoming the tech challenges slowly but surely, so great to have you here. Let me quickly just remind for people who may have missed last week's episode, we now have the ability for you to leave a voicemail to us. If you go to toptradersunplugged.com/voicemail, you should be able to very simply leave a voicemail, and if it's nice, then we'll try and bring it on air and get some more interaction from you listening to our conversation each week. This week, just as a quick market wrap, but I mean, it was really driven by the currency war declared by China in response to Donald Trump and other things. Ray Dalio was out this week with another article, raising some concerns for sure about this relationship, what this might lead to. And I guess it's really this escalation of tension between the US and China that, again, was at center stage this week, where the quote-unquote safety of government bonds was top of mind of investors. Even though you could say, I mean, for the US, for sure, there hasn't been a new high in bonds compared to 2016 and no new low in yield just yet. But it does seem like kind of the sentiment in the market has hit a new extreme. And I remember a few weeks ago, I asked both of you if you wanted to buy a 100-year bond or 99-year bond at 1.2% or something like that. And of course, you didn't. But there was a nice tweet this week just showing that 100-year Austrian bond in the last 12 months. And it's gone up by 80% in price, like really looking like a FANG stock. So it is quite extreme out there. Even with negative rates, people are hoping to buy these bonds and sell them, at higher prices to someone else. So with all that action in mind, Moritz, great to have you back. See how your portfolio is faring. We haven't heard anything the last few weeks about how you're enjoying the ride at the moment.
Always enjoying the ride, but yes, you're right. Didn't hear anything of you for the past 2 weeks, which is something I hated. I missed you guys, but apparently my portfolio didn't, because I've been on quite a good run the past couple of days, and the last fortnight essentially, with gold moving higher. Have substantial long position in gold. The bonds, I mean, I've repeatedly said that it's the gift that keeps on giving. Keeps on surprising every week and every day, but it is what it is. So the longs are firmly in there. Bitcoin's coming back, emissions sitting there, made good money by being short the pound against the dollar. Good P&L by being short the energy markets across the board now. So, all of that has ended up to about 6.5% positive in July. And up already 1.5% in August. So quite happy about that, and out of the red numbers for this year.
Yeah, that's nice, isn't it? That's great. Good to hear. I would say our week was, has been in line with what we've seen the last few weeks. So clearly fixed income dominating the performance. For us, JGBs, Japanese government bonds, was really the standout this week. Even though, I mean, you think about how low the yields are in Japan, but there's still something to be squeezed out of those trends, apparently. So we were benefiting from that. Gold, of course, shined this week as well, and made a nice contribution. Energy, as you said, prices under pressure, which is good for our shorts. Equities clearly struggled. So the long positions were hurting us in the US and Europe, but we're short Japan, so that was good. Currencies, yeah, British pound, the big high flyer for us as well, and the rest of the currency complex really saw some small losses, but yeah, solidly up for the month, for the year, and of course, we don't want to be too negative of this on this podcast, of course. But like we were saying at the end of 2018, that these drawdowns, as painful as they are, they don't continue forever. I also want to say, as great as these run-ups are, they don't continue forever. So I think at some point we're going to see some consolidation in the markets. And my main point here is just to say to investors, I mean, we don't know when these strong run-ups occur, and that's why you need trend following in your portfolio at all times. On the other hand, there's nothing to be concerned about when they do occur, and I think it's important to remind ourselves of those extremes, both the bad ones where we need people to hold on to the idea of trend following, but also be mindful that the trees doesn't grow into continue to grow. So we need to be cognizant of that at least. Anyway, Jerry, maybe trend following on equities will continue to grow into the skies. How was your week?
It was a good week. It's been a good period. On the bad stock day, we had some nice moves in gold that sort of helped us in Bitcoin. So the diversification, it's been crazy gold market. Every rally, every break has sort of not lasted long. So that's been a nice move. Some of the currencies seeing new highs in Turkey, shekel. India and Russia kind of sold off, I guess, at the same time. I had a good position in China before the big up day. I was able to find pretty much the only bond that got crushed this week. So that's a material position for me in the Italian bonds. I read something about something going on there, and the next thing I know, yesterday was a pretty bad day for the Italian bonds, but mixed bag in stocks. That is, you don't see if you just ride these indexes sometimes, but some are going up. On some of the days where the stock sold off, some of my individual stocks made new highs. So, it's just crazy. And but it's a nice period, and it seems like that the bonds are really just in a crazy place. I remember the night of the U.S. election, November 16, it was a big sell-off, and we sort of got run out of our bonds and then got short, globally short. And then all the articles from CTAs and from, non-CTAs sort of talking about, well, the CTAs have made a lot of money long bonds, but now that we're in this obvious kind of trade of being short the bonds and rates are going to rise, they're not going to make it as much money if bonds go lower as they did as bonds went higher. Here are the reasons. It's the contango or backwardization or something. And, it just reminded me of how that was so obvious, such an obvious trade, getting long the bonds at the high, short the bonds at the highs, that it's so hard to be contrarian. And, you're just saying, okay, great, let's just follow our systems. And that's just all I can barely do is just follow the system, follow the trend. Now the bonds are short. That's going to be fun. It's going to be great. But never in my mind was I saying at the same time, oh, this probably won't work. It's not going to mean anything to me as it relates to my position. I'm just going to follow my rules. But I get caught up in it as well. Like, okay, let's I guess we won't make as much money on the short trade, but yeah, I'm really against historically the obvious trade. It doesn't exist in my opinion.
I mean, very true. And also, I think a lot of people at the time, I mean, certainly when bond or yield started to rise back then, a lot of people were calling, for this to be the big change. And as I said in my intro, we haven't made new lows in yields in the US. So you could argue that the 35-year interest rate cycle still holds because the high was in 81. That's the last high we had in yield. And so far the low is in 2016. So that's exactly 35 years. But who knows? I mean, with what's going on right now in the world, and everybody is kind of trying to outdo the others in terms of negative yields, certainly in our part of the world. Who knows? Maybe we will see a new low, and the cycle extends a bit further. But again, making predictions about these markets is hard, and it's certainly not easy. It gotten any easier in the last few years with the at times controversial participation of authorities in setting market prices. So, yeah, interesting stuff.
I got caught in the same bond trade, Jerry, the same as you. It's the Italian bond. Italy's calling for a new election, the 44th since the end of the Second World War, which is kind of like, an average time of 1.5 years per government that they have, and then they re-elect, which is funny in and by itself. But, it's this fantastic country, which I love, but, they just have a new government every 1.5 years, and their bonds are massively more volatile than all of the other developed market bond markets. But, appropriately sized, not a big problem. But interestingly enough, we got information from our brokers that they will be increasing the margin requirements on the Italian bonds in light of the upcoming elections and what volatility that may bring with it. So interesting.
Yeah, absolutely. Jerry, so an exciting week continues to be pretty exciting in the markets. What about in the sort of the what do you call it now? Fin tweet or whatever the world is, social media, Twitter, financial insights from a lot of good people actually on Twitter nowadays.
Oh yeah, still my favorite thing to do. But it's pretty quiet week for me. I got busy or traveling a little. So, but as we talked about before we went on, Marco had some interesting CTA thoughts. It's just kind of funny and a chart attached with some moving averages on it. So I don't know what this means. And I think he could just call us up and say, what's your position? You could get a lot more intel. Some of these guys, I think Marco is particularly accurate, but some of the other ones are less accurate. And I have we are always mystified as to how they come up with CTA entry and exit points and things like that. But Marco says this week, the risk from CTAs is low as the S&P is stuck between key levels typically watched by the group. CTA traders may start selling when the index falls below its 200-day moving average. So the market is, I think rightfully so, trying to anticipate what CTAs are doing. It's a lot of assets and leveraged positions based upon low vol sometimes that can give a different impression as to if you don't use the ATRs and the volatility to kind of figure out what the CTAs are doing. But, with the vol targeting and as volatility picks up, the selling that needs to occur and then the buying that needs to occur when the volatility slows down, so it's probably a good idea for people to kind of spend some time thinking about what the CTAs are going to do. And it's good and bad because my trailing stops are long-term and far away from the market. So I have to sort of sit there and suffer on the minus 700 in the Dow days, but then, sometimes it rallies back, but it's kind of a pain in the ass.
It puzzles me sometimes to hear these big banks and well known and they get a lot of press, not just Marco. I think it's JP Morgan he works for, but there's also people from Nomura, et cetera, that spend a lot of time trying to tell the world about what the CTAs are doing. And I'm just thinking a lot of them, I don't say specifically these two guys, but a lot of them always come back to say, oh yeah, but if it breaks down below the 200-day moving average, you're going to see a lot of sellers selling from CTAs. Well, all I would say is that if CTAs were using that simple of models, that it would be as easy as saying, oh yeah, 200-day moving average, then you're going to see CTAs getting out. I mean, we wouldn't have spent 45 years at our shop to figure that one out. So I think people have to, understand that what we do today is a little bit more sophisticated than just looking at these obvious, well-publicized numbers. And therefore, I think it gets a lot of press, but I'm not sure it's really that accurate in terms of information. That's my opinion anyways.
I agree with that, Niels. I read it and then immediately after that forget about it. It's kind of like, there's entertainment is interesting because we're interested in systematic trading and CTA type of trading. And so every time there's anything in the news about it, we pick it up and want to see what it is. But I'm on your side there with those bank published market analyses on where the market is, where the CTAs are, how short gamma the street is, what that means for vol targeting. It's kind of like reading the tea leaves to a certain extent, I'm pretty sure. And, the content gets produced because banks are also active in the marketing game. They need to put stuff out. I'm not saying that they willfully put, things out which are incorrect, but, you need to take it for what it is. I don't think, it has a lot of accuracy to it.
The other thing I don't like about that part of it is that for many, many years, I think a lot of these institutions were very negative when you talked about trend following and no, I mean, it doesn't work, et cetera, et cetera. And then maybe, 8-10 years ago, they all came out and saying, oh yeah, trend following, we can do that and we can do it really well and we can do it very cheaply. So come along with us and we'll do it much better than the people who've spent the last 20, 30, 40 years working on this. And unfortunately, a lot of people believe them. So they end up buying a lot of these, replicators. But they don't, and they may get it cheaply, but you get what you pay for, and therefore the performance doesn't look great. It becomes part of the industry, and a big part of the industry. So it drags down the CTA indices performance as well, which means that people looking at that think, well, these CTAs really don't do very well. Well, I think again it's driven by the fact that you've got players in there, large players, who just make things too simple for commercial reasons, so they can attract large AUMs. But it doesn't hurt the investor, and I'm just hopeful that investors really see through that. Look at the net return. Don't look at what they cost, whether it costs you 50 or 100 or 200 basis points. At the end of the day, it must be what you get in return for that investment. And I bet you that these indices are not near close to the difference in cost compared to people like, the firms we represent and other of our peers. There's a big difference in my opinion. But of course, as I've said before, even with managers, size can become an issue and you lose performance at some point, in my opinion, when you go for size. And so people need to watch out for that as well.
I think to a certain extent, Niels, the interesting thing about this, I believe, is that it gives us an opportunity to outperform those benchmarks and those,
sure,
say naively constructed CTA type of models. I mean, when I see them and there's now billions of assets linked to those type of strategies, which trade, say, 30 to 50 markets, but only the most liquid ones, right? They're not highly diversified, at least not in my opinion. Mm-hmm. They're missing some, important ingredients. And then they trade according to some academic paper that just buys, like if the 1 month performance has been positive, you want to be long. I'm not saying per se that is always a bad thing to do, but I believe it's possible to outperform on those type of systems and do something that is better, producing a better return, maybe with less risk, but say higher risk-adjusted returns for a higher fee, but it gives us an opportunity to outperform against our peers, which I think is a good thing.
Yeah, absolutely. Jerry, we clearly had a lot of thoughts about your tweet there, so maybe you have other things we can dive into.
So I guess I was drinking some wine one night, and I just started tweeting thoughts coming out of my head. It's always kind of a dangerous thing. So I'll read these tweets, and you can just you don't even need to be gentle. Just give it to me. Let me know what you think about this. Since the outliers that drive performance are so rare, one must use loose, less specific rules that capture many trades that are small winners and losers in order to have the requisite sample size. a set of rules and is able to choose only the best trades can't be statistically legitimate. The more accurate your system becomes, the less reliable it can be.
Do you think we're going
like
to give
that.
you a hard time on that one? I mean, that's kind of like what we're saying all the time.
I think we must be drinking the same wine, Jerry. So
Good wine. It must have been a good wine, yeah.
Well, I got a lot of love from other people. One person did ask, can you explain a bit more about less specific rules? And I said, oh yeah, I should have said less fit to historical data. But I think he got my point. So, and there were some people who disagreed, but I do think that, we want to evolve, we want to get better, but we don't want to get too much better, because back in the day, the way that I learned was that, it's okay if your system has some C+ trades to go along with the A+ trades. So it's got to get those C+ trades in there so you can have something that you can rely upon.
and this is a bit of a stretch, right? But I think directionally I'm okay with this one. And that is, if you know the movie Moneyball, right? I mean, he didn't select, the best players. I mean, he selected a section of players that were, mediocre to a large extent, but they had a specific function on the team. But collectively, they did really well. And I think it's the same thing to some degree in terms of what we're trying to do. And what we've often said in our conversation is that, sometimes good enough is good enough, because as soon as you start being too clever with things, you actually put more risk into the future of your system, of your performance. So I think that you should drink more wine and send more tweets like that, Jerry.
It's always dangerous to drink a lot of wine, but it is a lot of fun. So I had one more. This is one of my favorites, I think, and I don't know. I always know what I mean in my head, and then I write it. I'm so proud of it. Not always. It doesn't age well always, but this was another one that I'm kind of interested in. A trend following strategy causes the markets to lose some of their inherent characteristics. The return of a market is replaced by the return of the strategy. There is no edge in the market, per se. The market is a tool to express the strategy's edge. So some people disagreed with this, and it basically revolved around the idea that, and I guess I'm talking obviously about a back test, and people disagreed that if you choose the wrong markets, you're not going to make as much money. You can't really separate the markets and your systems from the outcome. Obviously your outcome is what you've chosen in those two regards. But I do think from a trend following point of view, most people believe that the performance of the markets historically over the past 20 or 30 years of your back test might not be what that market might do in the future. And it's best to look at what the average trade was over all the markets, over all the data, to say that's kind of what I expect in the future from each individual market. Corn and yen may have been my best performers on the back test, but I don't expect that in the future. And then if I wanted to optimize the system for each market, I don't expect that to be what each one of those markets will be, what the optimal parameters will be for each one of those markets in the future either. So trading all the markets the same way is something that we say a lot, but sometimes I just sit around and think about what does that really mean? What are those implications? Thus, these tweets.
I read this tweet, Jerry, and the one observation and the one comment that I would make is, what is the market? If the market were everything that ever got issued or traded on an exchange, with all the things and all the stocks that go bankrupt and you keep them, where they're not in the graveyard, then that to me is a market. That's the benchmark. But if the market is the S&P 500, that's already a thing with an edge, right? Because it is a system that systematically buys stocks that have been going up, and it just disregards all the ones that have been going out of business. So you may say that the S&P 500 is already something with edge in it, compared to the market if the market were everything that ever got traded in this world?
I think we all agree that you need to treat markets in the same way because we don't know what the future is. I think that makes sense, but also think that when it comes to market selection, you have to apply, and I think that goes with anything or everything we do, regardless. I think you have to apply common sense as well, meaning when you start looking for markets to trade, if there's a market that just doesn't trend, would you even do the research on it? Probably not. But I think for me, it leaves one question that I'd love to hear your opinion about, just going off track a little bit from the tweet maybe. And that is, what if you have a model, like many people do, but what, for whatever reason, that particular way of dealing with momentum doesn't work on a particular sector. Let's just say that, stock indices and bonds doesn't work that well, but the same model works really well on all the commodities, for example, or currencies for that matter. So the question for you guys, would you just trade all the commodities because you get a lot of diversification currencies and leave out the equities and fixed income? Or would you try and find a way to trade those two sectors that doesn't work with this particular model in a different way and just combine it? Or would you just leave them out? Oh, sorry. And then the third option would be take them in, but then that hurts your performance. Sorry. So leave it out, trade them differently, or stick with them and see your performance go down significantly.
Hurts the past performance, right? May not necessarily hurt the future.
We don't know that.
We
Sure.
don't know
Yeah.
that. Yeah.
We don't know that.
No, leave them in. I'm in the camp of leaving them in and trading in them the same way as all the other ones.
Yes, I think that's the correct answer. You shouldn't split up the sectors. Just don't do it. I've done it. Okay, thanks for this good system. I'm looking forward to trading these new systems and parameters, but how did it do in the currencies? Don't ask. For God's sakes, don't ask how it did with the shorts. So you just close your eyes. Don't ask these bad questions, and go forward, because it's just like Moritz said. The back test is the back test, and a fundamental tenet of trend following is you can't predict the future, and this sorting is irrelevant. But then I would also, I know you didn't mean this to be part of the issue, but honestly, given that question, I would be very concerned with did the system that you're talking about, did it overfit the historical data in those other markets? That good performance in the other sectors is something that might not be reliable. And I kind of have run into this before, in that at some points in time, stock trends, the single stock trends or indexes too, were so good that you had to be very careful how you're weighting in your back test to stocks, because what those parameters that fit the stock trends the best were so awesome and so good that you would start trading the other sectors the same way, and the stock performance was way too good, and so you need to be careful, that overfitting that historical data in the stocks would make you choose systems that were a little too curve fit. So it's tough. I think when you do the back test, weighting the different markets and having the back test reflect great performance for one sector or two sectors can give you a false impression.
Yeah, I'm not surprised by your answer. I think that's what I expected, and I'm sure our listeners as well. But I think you bring up a good point in answering it, and that is, this is exactly the same as the issue with the shorts. Because when you do your analysis on a trend following system, you will find at least for medium to long-term trend following systems, that most of the profits come from the long side. But does that mean you should not trade the shorts? In our opinion, no. I mean, you need to take it both ways, so to speak, maximize the diversification. So good stuff.
I remember looking at the grain markets, I don't know, 5 years ago, 10 years ago, and they weren't profitable. I don't think they've gotten profitable since. So just one of those things. We sort of talk about how clients need to look at things in a longer term point of view, and how short term doesn't mean a lot. And I think that goes for the back testing as well. You don't want to kick the grains out because they haven't had any uptrends in a while. And the longer these markets and sectors go without nice big uptrends, 50, 100 ATR moves, the more their historical performance deteriorates. And this is, I think, another thing that makes it so difficult to be a smart person, a person who is interested in research and evolving and finding out good ways to trade. It makes it, it's very difficult to sort of say, when someone comes and says, let's improve the shorts, let's improve the grains, there's kind of like philosophical rules in place where you say, oh, I wish I could, but I can't. And most people are like, well, I can, and I will. And that's where I think they get off track with, a lot less robustness than the rest of us, who we sort of suffer through this robustness sometimes. Because it definitely looks like you can fine tune these systems a lot more and evolve, quote unquote, a lot more than I say we can. I'm pretty set on pretty much sticking to the way I've been doing it for a long time, and it just destroys your creativity sometimes.
It brings back quite well the point you made earlier, Jerry, and that is a few years ago, a lot of people were talking about how it would be impossible to make good profits in bonds now that the yields were rising. Well, this year it's proven that, they don't actually have to rise just because you think it's going to rise. And secondly, bonds have been on fire and really been the main driver of performance for most trend followers. So yes, I mean, you're absolutely right.
And the way I've described CTAs and investing in CTAs before is that, CTAs are the only ones dumb enough to still be long bonds, or only ones dumb enough to still own stocks as the valuations got crazy. And this was 3 or 4 or 5 years ago, valuations were crazy. So I mean it in a loving way, that we can't predict, no one can predict, and staying with the trend sometimes the only thing that's going to work. And you need to have part of your portfolio that at least, my opinion, 90%, but at least 10%, let's say, that looks at the markets in that particular way.
Absolutely. What else went through your Twitter handle, so to speak, this week?
So I'm on this anti-private equity kick. I love making fun of private equity, and it's sort of a hot area these days, especially in the U.S. Something that I think that I've read research papers on that can easily be duplicated by just holding small cap stocks. But so after the day after the big sell-off in the S&P, I tweeted, so I guess private equity was flat yesterday. Thought it was pretty funny. It probably was flat because they don't mark to market.
That's right. It's the optimal strategy when it comes to creating a smooth curve, right? I mean, you set your own price, and darn it, it's pretty straight up, nice and smooth.
And you can charge higher fees.
Oh yeah, of course, yeah.
And I'm just jealous that my clients can see the daily performance, or monthly. If we could report back 2 or 3 years at just the right time, life would be a lot easier.
Yeah. Interesting stuff. Are you ready for a couple of questions? A few questions?
Sure.
Or do you have more? Okay, cool. We can
Are
always
we really
go back
going
to the
without mentioning Wayne? Is this what we're doing now?
Yeah, we're going to give Wayne a week off.
Okay, next time.
Well, first question is from our friend Sam, and sorry, Sam, I missed this question when we were doing it last week. So we will definitely do it first this week. Okay, the email goes like this. I'm back again trying to push you guys to the extremes. So I would like for you all to discuss what you think is the benchmark trend following Sharpe ratio. It seems like one should expect they are a 20% vol and a 10% return and drawdowns up to around 40%. Do you agree? Is this a solid benchmark to try and improve upon? Also, in your decades of collective experience, possibly a century, what is the max Sharpe you have seen from what you would consider to be a true trusted trend following trading system? I think it must be. I understand your unhappiness with the Sharpe, but let's use it since it's an industry standard. If you want to completely ignore it, please state why and its appropriate substitute. Let's start with that. There's a follow-up. Moritz, since you're back and have rested your voice for a couple of weeks, why don't you run with this one first?
Full of energy. Okay, so the Sharpe. I think I've said it before. To me, this is my personal opinion. A 0.5 Sharpe is good enough. I'm happy with 10 vol and 5 return, or 20 vol and 10 return. That works for me. Now, but as far as benchmarking goes, what do I compare my trading results against? There's the Société Générale CTA index, formerly the New York CTA index, which is essentially a basket of CTAs out there, grouped together. There's the BTOP 50 or BTOP 40, I think BTOP 50 index. And those benchmarks I have looked at. And I also benchmark my trading system against, we call it some naive type of trend following strategies. Things which, I run, which are run without money being put onto that. But, simple type of things like, the 200-day moving average that we've mentioned, like a moving average crossover, those type of things. And I just want to see where I end up compared to those type of systems. Now, in terms of what is the Sharpe ratio that's good enough? Was that the question, or could it be better than 0.5? I mean, of course. I mean, there's years where the Sharpe ratio is 0.8 or 0.9, but there's also years where it's considerably less than 0.5. As far as long-term trend following is concerned, and the way that I trade, I don't see that system, and I haven't seen any other people trading in that way producing Sharpe ratios which are consistently greater than, say, 0.901. I think that would be exceptional if you had a long-term trend following system to come up with a Sharpe ratio that's higher than 1. I don't see that.
Yeah, I don't care about the Sharpe ratio. I think that Moritz. I think Sam's question. I didn't understand. Like, I think we've said that Moritz and I have sort of said that the average annual return, maybe the drawdown is twice that. So 10% return would maybe come in around a 20% max drawdown. You might get to 40 or 30, but I guess, but hopefully not, and that's probably rare. But so I think something like that is a better replacement. You can trick the Sharpe ratio, and people trick it all the time. For instance, vol targeting tricks it because if you get out of a third of your position at all-time highs, then that portion of the trade has an infinity Sharpe ratio. So that may be, after 20 ATRs, and the market goes 120 ATRs. And then after 120 ATRs, I have a 20 ATR drawdown and I make 100. My Sharpe is not going to be as good as a vol targeting person who may have had much smaller profits on a particular trade, but kept liquidating at close to the trade's max profit all the way up. So I made a lot more money. I seemingly look a lot more risky, but it's just fake numbers. So I have no tolerance, but on a slightly different subject, Sam is one of our best listeners, and he's a good guy, but he kind of crossed the line a few weeks ago by posting this picture of me like about 25 years ago when I was much younger, but I was much heavier. So, but I think we're back to being friends again, Sam. But push us to the extremes. That's where I like to live, on all these extremes.
Yeah, so I'll try and answer it in a slightly different way, Sam. For me, I think this is something AQR, maybe it was Cliff Asness saying it on a podcast or writing it in a summary, that in the long run, all asset classes probably has a Sharpe around 0.3, something like that. And I actually don't think, even though we obviously right now don't think equities could get down to that level of Sharpe, but it can when once you expand your time horizon long enough. And I don't think CTAs are that different when you look at the benchmarks. I mean, I really think that that's where we're, I don't think we are as an industry better than 0.3 ish. But you shouldn't, but that's an average. It's an average of certain managers, and I don't think you should strive for being average. So, with like Moritz, and I would certainly say I think it is doable, not easy, but I think it's doable to get to 0.5, 0.6 net of fees. I mean, gross of fees, that difference, and keep in mind that all these equities are, by definition, gross of fees. So, but net of fees, which we report, I think once you get to 0.5, 0.6, it gets harder. And obviously for a shorter period of time, you can get above that. What's interesting is that we track the performance of the index of CTAs in 3 different time frames that just hits certain changes in our own system that is relevant, and therefore I have the numbers for it. But just to give you an idea, I mean, the Barclays CTA index that Moritz mentioned, and since 1984, November 1984, which is the time when our program started, the average annual return is 6.85%. But since 2006, just before the crisis, we're now down to 2.39% on average since 2006. But since 2013, so the last 6 years or so, we're down to 0.82% annual average return for that index. So you don't want to be down there. I mean, you don't want to be just an average index. And therefore, you would also expect that the Sharpe ratios to be somewhat lower nowadays than they used to be. But I still think for the good managers, you should look for managers who can deliver 0.5 and above. I think that's a good level. I think I forgot the other question that you mentioned, if there were any other benchmark, but I think Moritz touched on most of that. I mean, I think obviously for the 3 of us, the most obvious benchmark is the CTA Trend Index, which is doing really well this year. It hasn't done dramatically well as such, but I think it's probably the most relevant index that we should beat. For sure. Okay, let me go to the second part of the question. Secondly, could you ever possibly conceive a situation where a portfolio has too much diversification? For example, I'm heavily into spot currencies. I'm in 40 different markets. If currencies are 25% of my total allocation, I still may be attempting to use 75% more outside of currencies on top of those 40 markets. I would like for you to push yourselves to the edge and think about the theoretical limit if it exists. So I guess that is, can we over diversify is the key question, which I think we've touched upon before. So, but let's see what your thoughts are today on this Sunday in August. Can we be over diversified?
No, I don't think you can. I'm a big, massive fan of diversification. And I don't think there's a theoretical limit. There are statistics that will show you that the extra benefit of an additional market, the diversification benefit that you get, declines with every market that you add. And I think that's true, right? But there's still a value add. So there is no theoretical limit. I think the limit may be operational, impact. Do you really want to be trading 7,000 markets, 8,000 markets, if the 8,001 market doesn't really add that much to your portfolio, maybe you want to skip that. But I'm far away from that. I'm not in those type of spheres. But what the way I do it is, before putting a market into the portfolio, I look at the market, I look at its properties, the correlation to other markets within my portfolio, and I make an educated guess as to what that market is. It's Belgian power or Nordic power. So yeah, I like that market. It's not going to have lots to do with my oatmeal position or Bitcoin. So it's very independent. It adds diversification to my portfolio, and really, the more of those gems I can find, really independently moving markets, the better it is. And then I definitely want to put them in. And I don't think there's a limit. This diversification, every little bit helps.
Yeah, I mean, I agree, and I think you have an edge with your system, and spreading that edge over lots of different markets, longs and shorts. There is no over diversification. The best CTA or systematic trend follower with the best portfolio, the most markets, and the real true diversification is just going to always be underperforming because they just have this smoother return. And so, and maybe overperforming in bad periods because it's just closer to their average return. So the ultimate system would be I make 10% almost all the time, and some years I make 12, and some I make 8. And so that's what the great diversification would sort of look like, this hundreds or thousands of markets. I do think another problem happens to CTAs, and personally me, more so in history than now, but is that I don't think it's over diversification. It's just I've talked about this before, which we've got a lot of markets that we trade, not that many, but that are truly different. Cotton, coffee, cocoa, sugar, cattle, emissions, palladium, and then we trade 4 energy markets that are 90% correlated, or European currencies that are very correlated, or way too many bonds, and the chart pattern is the exact same. So we like to talk about we trade 100 markets, and we love making money on all these bonds. Don't get me wrong, but I think to some degree there is something going on with diversification that produces massive drawdowns because we're basically over trading certain sectors and trading in markets that there's just not a lot of difference between heating oil, crude, and unleaded, or the Swiss, the euro, and krona. And you can do the same with equities. That it's great when you have these big uptrends, you're making lots of money, but they all go down at the same time. And so that, I think, is something that needs to be addressed. I don't know if it's over diversification, but it's not real diversification.
Yeah, I like that. Things though is that we can adjust the position size of those. We know those markets are correlated, like you say. The energies, they are correlated, but sometimes they're not. I still want to trade heating oil and gasoline. I think it makes sense to have them both in the portfolio, but I don't need to, knowing that they're correlated, I can adjust the position size of those markets and not trade them in the same size as corn.
Yeah, it's funny. I mean, I'm kind of in between what you're saying. I don't necessarily fully agree, if I'm perfectly honest. So on our side, we treat everything equal. So even within energies, we treat them the same. We're also different in the sense that we don't trade 100 markets. We trade 55. And we've never traded 100 markets. And I don't see any evidence that the more markets you trade, the better your performance is. It might be smoother. I'll definitely, it could be, but I don't think it's better. But I do think that it comes back to what Jerry was saying. It's what are the underlying return drivers in your portfolio? And so clearly, different commodities have different return drivers. for sure. We know stocks have become more correlated over time. Central bank policies are more coordinated. So there is definitely in the financial markets, there is more correlation than there has been before. And you need to have systems or risk management that takes that into account. But for me to sit and say, well, I should trade this market half size, this market, full size, I think you're introducing some subjectivity that, goes against the whole thesis of being, not knowing what the future holds. That's just my gut feel.
Yeah, I mean, I don't agree with my thoughts on this sometimes either. I mean, but I think it's a very interesting topic, and I agree though you wouldn't necessarily make more money. I don't think there's more evidence that there's evidence that increasing the markets makes more money, and it's only about smoothing things out. That's the only thing it's about. So I agree with that, but. And then I agree that you don't need to trade 100 markets. That's sort of the point I'm making, because you only have 45 unique markets or 50 or something like that. Uh, and that's my point. Don't trade all 100 markets, heating oil, crude, and unleaded, the same size, because it's still one market. Now, uh, so I now follow the approach that Moritz takes, which is I understand that they're correlated. They're not always correlated, and it is worth trading all three at a reduced size. And so if I didn't want to do that, then I would just pick one and trade it. But I've said many times that heating oil doubled in Feb 84, December 1990, and crude kind of sat there. Silver doubled. Silver had a tremendous move in 1987. Gold kind of sat there. And gold has had a huge move this year, and silver is sort of hanging out at the breakout. Platinum, that I consider to be almost the same as gold, it hasn't even made the breakout yet. So you've got to kind of say, I'm going to live with that because I'm a risk manager at heart, and they're kind of similar. And I'm not going to trade a lot of stocks. I'm not going to trade Coke and Pepsi. That makes no sense. Okay. So I think that mentality needs to be brought back into the futures markets that we trade, and understand that you're going to be wrong sometimes. Heating oil is going to double. Crude is going to be the one that you want it to be in, but then it goes back to being 90% correlated. And I don't think there's any problem with trading, splitting up your unit size for the energies into 1/3 crude, 1/3 heat, 1/3 unleaded, or something like that. I don't think mathematically or statistically, as long as you maintain that consistent approach going forward, that there's anything wrong about doing that. You don't have to trade everything the same size. It's really just a situation of when you make these decisions, just try to stick with it in the future and be more disciplined and consistent.
Yeah, absolutely. Well, I think Sam just did it again. Really, he got us going on these topics. So appreciate that, Sam. Well done. All right, next question. Walter send in a question. This is completely different. A question I don't think we've had before. More of a kind of behind the scenes question about running a trend following fund. So I think it's good to hear these kind of things. So Walter goes, big fan of the podcast, listen to every week religiously. I've got a couple of questions. Assuming your fund is denominated in US dollar, how does it work when you trade contracts that are not denominated in US dollar? I assume that if you're trading the German Bund, the only euros you need are to post margin for the Bund. Do you hedge out this currency exposure? Question mark. What about any profits from the trade? Do you turn them back into dollars when you get out of the position? Also, when backtesting strategies in US dollar that trade futures in other currencies, I'm assuming I need to adjust the return to reflect the changes in price of the contract, but also the change in price of the currencies. Let's start with that quickly. March, do you want to get a quick answer, or do you want
Yeah, I
me to
can.
dive in? Yeah.
By the way, I like the question, Walter.
Yeah.
It's a very good, very fair question because we're trading contracts in different currencies: the Hong Kong dollar, Japanese yen, euro, dollar, everything. So what happens here is in your example, you've mentioned the Bund. You have a US dollar denominated fund, but you're trading Bund futures on Eurex, which are traded in euros. So the Eurex exchange, the clearinghouse, will demand an initial margin from you, which you can either pay in euros or in government bonds, which they accept. But let's just say you pay cash. The euros you give to the Eurex clearinghouse, you will get back 1-for-1 by the time you close the position. There's no exchange risk on the initial margin. But what happens is now over time, as you have the position open, it will produce what's called variation margin. That's your daily P&L. It settles daily, right? Up and down. So your account will either be, if you say, you've purchased Bund futures and Bund futures go higher, then your account will be credited with euros. If they go lower, your account will be debited with euros. This cash position does have FX exposure. And the way I do it is, I don't want to be exchanging that back to my home currency every single day. That would be too cumbersome. So I have some thresholds whereby I allow the different currency exposures in my fund or in my account to go up or down to a certain level. And once they breach that, I make a currency conversion back to my home currency and then start again.
Yeah, makes sense. I think this. What about you, Jerry? Anything to add?
I think that's perfectly fine. I think I ignore it. But I think that could get out of control. So I think every now and then you need to look at it and maybe readjust, like Moritz mentioned. And obviously, when you're putting together your equation for your quantity, that includes ATR, tick value. You need to multiply that times, like I would multiply that Bund times the price of the euro to sort of put it into dollar terms. Yeah, but it's not going to be perfect. You're sort of faced with the issue of if you theoretically make 10 ATRs, then actually you're going to make 11 or 8 when you P&L all this out and you have this currency fluctuation. But I think we've researched it over time, and it kind of sort of a break even.
Yeah, and I would just add to these answers, Walter, that if you do run a backtest, if you have the ability to do so, and I think it makes sense because you go back many years, that is to then have some kind of currency exchange rate running also at the same time, so that you can account for changes in currency along the way, because clearly the euro in the last 25 years has been, fluctuating a lot versus the dollar. So there is, and as Jerry said, in your risk budgeting, you need to know whether you're trading a euro or a dollar, so to speak. It does make a difference. So hopefully that gives you some of the answers you're looking for. You had a follow-up question which goes something like this. You guys talk about the paper that looks into the percent of stocks make up the most returns. I think we talked about this earlier, there's a small, I think maybe Moritz had these statistics, a very small number of stocks that makes up most of the return. I've seen the paper and read other similar studies. I think the conclusion most people reach is that since it's such a small percentage, and since it's hard to know which stocks are going to be the top, then the best solution is to index. Also, I've heard many people say that shorting is very difficult since stocks mostly go up over time. But aren't these two conclusions contradictory? If most stocks fail to beat the index and a significant percentage of them fail to beat T-bills, then shouldn't shorting be easy since chances are that you short a stock that doesn't even beat T-bills? Brackets, all of this before cost, of course. Obviously, it isn't that easy, but I failed to reconcile the two conclusions. Would love to hear you guys' thoughts on this. this is probably more in your ball game because you, well, certainly Jerry trade single stocks. Any thoughts on that?
So last week we had a tweet and we talked about it on this particular subject, and so my solution, I gave three choices to that paper, that fact that one point it was 4%, and then the latest article last week that I mentioned was I think down to 1.3%. So my three solutions were index, or do you want to index? Do you want to find the 1%? That seems hard. And then the third was if you trend follow the stocks, almost all of them become profitable. And you eliminate that fact that only 1% or 4% are profitable. In fact, I quoted that study. I asked my friend Eric, I said, he told me he did a study of trend following stocks that no longer existed. They went out of business, they were bankrupt or got bought out. And when you trend follow those losers, those markets make about the same amount of money as the stocks that still exist. So back to my quote tweet that I had to the beginning of the show. Trend following strips the markets of its characteristics, 96% losers, 99% losers, and turns them all into something else. It's a tool to manifest the edge of our strategy. So with trend following, none of those things are true.
One thing I want to add to that is that those statistics, that say the return has been driven only by a small number of stocks, they look at the overall stock market. I just want to, for practical purposes, say that most of those stocks, including all the pink sheets and all the super small and micro caps, you wouldn't be able to short them to begin with. So I believe to a certain extent it's a theoretical exercise because those stocks are so small, so illiquid, there's no sec lending market on those. So you may think about shorting them, but in reality, you probably will not get a quote. You won't find a bid to short that stock.
Cool.
But don't you think that if you just limited it to the top 500 stocks, I think the numbers would be similar? And I think,
okay, fair point.
Yeah.
And then you're saying you can short those, right?
I think the problem I'm guessing, but I think that you can have it both ways. It's not a contradiction, because I think the problem is this infinite holding period. So yes, if you're short, if you find the 96% or 99% to be short, you will, if you can hold on to them as they make hundreds and hundreds of percent in a bull market, then finally collapse in 2008, and they're vastly negative. And that's the problem. You can't hold on to these losing shorts. They're going to turn into losers, but you may have to hold them and hold losing positions as they rally, along with the elite 1 to 4%.
Yeah, good point.
All right, I'm going to jump straight on to the last questions from Jeff, as we're a little bit pressed for time on today's recording. Jeff starts out, first off, your podcast is absolutely fabulous. Please keep up the great work. The podcast is wonderful, informative, and brings non-professional investors like myself up-to-date information and ideas that I don't believe are generally accessible to non-institutional traders. Your podcast focuses on trading the systematic way with each episode. I love it. I can't get enough. Thank you for that. Of course, Jeff, with an intro like that, of course, we will take your questions. So, your conversations spur so much thought that simply cannot get from reading books on systematic investing. For example, listening to Jerry Parker, Mr. Turtle himself, discuss how he struggles with natural urges to override his system even after 30 years of trading, questions whether his system works in the market, etc., how parameters need to be changed to reflect changing markets, has been absolutely eye-opening experience. Here's my question. On the podcast, Jerry discusses exits using ATR multiples as trading stops and how exit ATRs are larger now than they were in the 80s and 90s. Other than potentially larger drawdowns, what are the risks of using larger ATRs multiples for exits? That's one question. And then he goes on to say, I believe you, that's me, stated that done, you do not use ATRs for exit outside of moving average crossover. What types of exits are typically used? And can you point me to any resources that would discuss alternative types of exit strategies? Do you want to start off, Jerry, talk about your view on ATRs?
I think it's useful to use ATRs for sizing your position, and then use them as a multiple ATR for a stop loss, and then use breakouts and moving averages or something else once the trade becomes a profit. I think that when I first started trading, the ATR losses were small and suboptimal from day one, and so now it's more optimal. I think the number of ATRs you used before you exit with a loss is somewhat correlated to your winning percentage. So if you use one ATR, as soon as it's one ATR against me, I'll take a small loss. Your win percentage is going to be lower than if you use 10 ATRs, which is probably too many, but that's going to be kind of higher win percentage. So it's just give and take a little bit on that. And there's probably like an optimal level that you can uncover in a back test. And then I'm not sure that using a stop loss improves performance on the back test. I don't think it does. Really, it's not. It's kind of a break even, I think. You can use them or not use them. It's one of these days you're going to get 10 losses in a row and wish you would have had a stop loss. And then some, but more frequently, I keep getting stopped out and having to get right back in. So it's one of those given pros and cons. It's kind of not a big deal, probably.
Yeah, I think actually just what you responded there also covers a little comment that Jeff makes in his emails that talks about the whole point about being whipsawed and how if you use, bigger ATR multiples, you could have stayed in with certain trades and so on and so forth. But I think, Jeff, as you can hear from Jerry, I mean, there are pros and cons. And, if you get 10 losing trades in a row, then using a 10 ATR compared to a 5 ATR may not be such a good idea. So, you have to test, you have to find something you're comfortable with in that regard. With regard to the question about what we do at Dun, I mean, we use a couple of different approaches. One, we do use a breakout model, so clearly volatility plays a part, but it's more reversals we're looking for as the trigger to also get out, so to speak, although there are obviously, possibly quote-unquote stops along the way. But then we also, I mean, but there are also other ways you can look at getting out of markets. I mean, you can, you don't have to just use one methodology, whether that may be moving averages or other ways of exiting. There certainly are different ways of doing it. And I think I'm being a little bit cautious here because we spend a lot of time on exit strategies, and I think it's one of our sort of secret sources how we do that. So I probably can't be too specific as to precisely how we do it, but I think there is a lot. I'm on the opinion that there is a lot of work to be done, a lot of improvements to be found. On exits, even though I also agree that entries and risk management, et cetera, is important as well. So, but we love the question, we love your comments and your support and all of that. So, but with that, I'm going to leave the questions for this week. I'm going to jump straight into a quick update on performance, guys, if you don't mind. And then if you have any final thoughts afterwards, we can quickly do a discussion of that. But anyways, as we have indicated, it's been a good start to August for all the indices. The beta 50 is up 1.56% for the month of August, up 10.22 for the year. SocGen CTA Index up 0.71 for the month, up 9.28 for the year. The Trend Index, the one we probably should be tracked against, up 2.52 for the month, up 15.45 for the year. The Short-Term Traders Index up 0.58, up 1.80 for the year. And the British Alternatives Index up 3.80, up 13.3 so far this year. Of course, we should not forget to just mention that we've got only a few spots left for our live event in Lower Manhattan, a couple of months, 2.5 months from now. We would love to find the last few people who want to join us. But as it is, first come, first served. Do reach out to us if you want to be part of it. I think it's going to be a very unique 2 days for those who come, and also time to do some socialization and socializing, whatever. And of course, what the benefits of live event brings is that you form strong relationships with other peers that might come in very useful in the years to come. You can find the details of the live event if you go to toptradersunplugged.com/live. Jerry Moritz, what else do we want to discuss on this Saturday, actually, it is. I think Moritz is speaking, but I think you're muted, Moritz, if you're trying to speak.
I'm sorry. Yeah, I was muting.
I saw your lips were moving, but I thought you normally speak a little bit.
Yeah,
louder
it's good now that we can see each other on that new application. But no, I was saying I'm fine. Nothing more to add. It was great to be back and hear your voices. Looking forward to next time.
Yes, same here.
Good stuff. If you want to support the podcast, of course you can. You can always leave a rating and review. They help a lot, and we've made it easier for you to do so. You can just check it out on toptradersunplugged.com/review, and don't forget to leave us a voicemail. That would be great fun if we had a steady stream of those. But anyways, thanks for spending your time with us today, and of course we love the loyalty you show us each week. And we very much look forward to being back with you on next week's edition of The Systematic Investor. And in the meantime, have a wonderful week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time